a HECM first mortgage, you're going to get basically two options in terms of loan type. You can get a fixed rate loan or an adjustable rate loan. Now, on the fixed rate side, it's not like a traditional 30-year fixed rate loan, so to speak. It's not like when you get a traditional forward mortgage and you apply for that 30-year loan, you've got, fixed interest rate, fixed payment for 30 years. The HECM does work a little bit differently in the sense that if you decide you want to get a reverse mortgage, the amount you're going to get is going to be based on a combination of your property value, your age, as well as what's called the expected rate, which we'll get into later, I think. But once that's established, then you have to decide how you want to access those funds. One option is to access the funds with a fixed rate reverse mortgage loan. Now, that actually is not done as often as you would think, even though overall, when it comes to first mortgages, forward mortgages, fixed rates by far are of greatest demand. Not so much with HECM reverse mortgages. Part of the reason for that is both with the fixed rate option and the adjustable rate option, when you are getting a HECM reverse mortgage, there is a limit to how much you can access the first year. The limit is 60% of what's called the principal limit. The idea there is to avoid problems that occurred in past years where a HECM borrower would get all of the money available all at once, lump sum, and then run into financial problems being able to maintain the property, both in terms of expenses, taxes, insurance, maintenance, utilities, and so forth. So a few years ago, the program was tweaked to limit how much you can get the first year. And with a HECM fixed rate loan, oftentimes that limit will be hit. And the important thing to understand with the fixed rate HECM option is it's a one-time deal. In other words, when you get that loan, and if the fixed rate lump sum amount that is available is sufficient for your needs, then the borrower may take that option. They get that lump sum amount, and then they're done. There's no ability in the future to like pay down the loan if you choose to make payments, because again, you don't have to. That's the whole focal point of reverse mortgages. You don't make payments. But if you want to, thinking you can pay down the balance and then somehow reaccess that original principal limit amount, that's not allowed. It's a one-time lump sum distribution, and that's it. And then the rate's fixed for as long as you're in the home. So in a lot of cases, the fixed rate option is not as popular because of that limitation. Now, with the adjustable rate option, and the one that we use most often is a adjustable that is a monthly adjustable with a 5% life cap. The nice thing about the adjustable option is more flexibility, because you don't have that one-shot lump sum distribution and that's it. Again, you are still limited to that 60% limit the first year, the first 12 months. But if the total principal limit available to you is more than that, then the beauty of the adjustable rate mortgage option for the HECM is that you can take whatever amount you want in that first 12 months. You can take all the way up to that 60% limit or some portion thereof, but then the rest of the available principal limit amount is still available to the borrower after that first 12 months. And then you have the added flexibility of a multitude of ways of accessing that additional money after the first 12 months, either through a line of credit that grows over time, fixed monthly payments over a specific term, or fixed monthly payments for lifetime, also known as a 10-year option, or a combination of all three. So as a consequence, we do find that the HECM adjustable rate loan is by far chosen more often than a homeowner looking at the fixed rate option.